Throughout the past 2 years, I've developed a system that consistently gives me days like this, and this, trading only 3 hours a day, but achieving an 87% win rate and over $20,000 per month. Now I'm about to show you exactly how it works. It's so simple that even a beginner could not mess it up once they understand the 3 core principles that I'm about to teach you. And the best part, this shows up every single day on the market without fail. Today, I'm going to show you my complete TRLS system and walk you through real-time examples to show you just how well this system actually works. By the end of this video, you'll understand exactly how I achieve this level of accuracy and also understand why 99% of traders are approaching the market completely wrong. Now, before we dive into the mechanics, you need to understand that the TRLS is built on 3 fundamental pillars. And once you understand these, everything else will make perfect sense. So these 3 pillars are what separate profitable traders from everybody else, and most people are going to get at least one of these wrong. Now, the first pillar is the foundation that everything else builds on, and most traders get this wrong from day one. But if you mess this up, then nothing else actually matters. So pillar 1 is market structure. Extremely simple, but essentially understanding how to actually identify a trend is the easiest way to become profitable in a market. So you can see quite clearly we have 3 examples of a market right here. First one is going to be a consolidating market. We are literally pushing up and down, moving almost sideways, and there is no clear direction. The second one is going to be a bullish market. You can see quite clearly every time we put in a high right here, the next high that is made after that is higher than the previous one, indicating we have higher highs followed by lower lows. So every time a low is put in, that next low is higher than the previous one. So now we have higher highs and higher lows, which is indicating a bullish market trend. Alternatively, we have the same thing on a bearish market. We have a lower low followed by a lower high, followed by an even lower low and an even lower high. So each high that is being put in here is lower than the previous one. And each low that is being put in here is lower than the previous one, which is indicating a bearish trend. But here's why 95% of traders mess this up, and it's costing them thousands. Now, I made the same mistake for months before I figured it out, but a lot of people are going to think they've identified a change in market structure when they actually haven't. So a lot of times what's going to happen is the market could be trending one way. Let's imagine it's trending bullish, and essentially you come down and you stop making higher highs and higher lows, and you actually make a lower low. So most people right now would think, okay, what's going to happen right here is we're going to see a market structure shift to the downside, and let's jump in some sells to take advantage of that. But here's why they're wrong. A lot of the time, what the market will actually go ahead and do is go and make an equal low or a slightly lower low, just like this. And then what happens immediately afterwards is the trend continues and follows up, trapping those sellers and essentially now leading to a lot of people being stopped out and being in the wrong direction on the trade. But here's how you can avoid that. So once you understand structure and how to identify the trend in the market, the second pillar is going to become obvious. And this one is where the real money is made. Smart money is leaving its footprints everywhere, and you just need to know how to read these footprints. Now, this right here is going to be liquidity, which is the second pillar. Essentially understanding where the liquidity is in the market and utilizing that to take a position in the favorable direction. So you can see quite clearly if we drop down onto the market for a live example, you're going to see right now exactly what we saw in the first pillar happening right here. You have essentially had consistent lower lows and lower highs being made, indicating a bearish trend. Now, what happens next is exactly what I just showed you. You end up actually coming up and making what people think is a higher high, which essentially breaks this high right here. But what actually happens next is we just continue straight down with the trend, and you're expecting to see something like this. Now, if you understood liquidity and understood how the market moves, you would have been able to avoid this. And the way that you do that is very, very simple. The first thing that you can identify and use to understand liquidity is by looking at session highs. Now, you can quite clearly see here, if we dial into the lower time frames, liquidity was being grabbed from above these session highs over and over and making moves in the opposite direction. So once you understand that, you now understand that when we're making these highs, as you can see, which looks like a change in market structure or bullish market structure like this, what actually was happening is liquidity was being grabbed to fuel an overall move to the downside. Now, once you understand that, you can actually realize waiting for a sweep of a session high or session low is essentially going to give you some liquidity to drive you in the right direction. But that's not the only way. The other way that we can quite clearly look at liquidity is by looking at ranges. Now, I've made previous videos on how to understand support and resistance levels, and these are extremely clear. But the most important thing is, once you break out of a range and sweep above a range high or above a range low, you're essentially going to realize that is just a liquidity direction. And once you start to confirm and move in the opposite direction, that is really when the optimum move is going to be made. So what is often going to happen is, as you can see, as we come up towards the top of a range right here, you have a resistance area towards 62 up here. And essentially, people might think, okay, we're looking to close above the range, we're going to break out and continue up. But all that happens is a sweep above the range like this, and a straight continuation down. And then we try again, a sweep above the range. And again, that is our liquidity to fuel the push down. And vice versa from below. You're going to see the exact same thing happen here and everywhere in the market. You sweep below the range low and actually end up continuing in the opposite direction. Now, essentially, the way that liquidity works is orders resting above highs and lows. Now, once you understand this, you need to understand that the market is being fueled by these orders, and it actually cannot move until it has come down and collected these resting orders. So what the market is going to do is it's going to come and quite simply tap into levels. And let's imagine we have a large amount of buy orders right here. Once these buy orders gets filled, that is directly putting liquidity, i.e. money, into the market, which fuels a move to the upside. So whilst people are getting in sells right here and getting trapped out, you're essentially going to see a lot of people buying, and that is liquidity fueling the market to continue up. And as the market continues up, the people who got in the sells from down here will end up being stopped out. And that again is another buy order, because a stop loss is a buy order for sells. Then essentially you are buying back into the market even more and leading to a further push upwards. Now, if you took advantage of this, you would have been in the right direction and saw a very, very strong move to the upside. But if you're in the wrong direction and you didn't understand liquidity, you can get wrecked by this extremely quickly. Now, you might think you understand liquidity, but there is a trap here that catches almost everyone out. And I fell for it for months. That is liquidity grabs on the lower time frame, and actually what I like to call fake out liquidity grabs. Now, let's just zoom in right here for an example. As you can see right here, one of my main confluences for entering a trade is the liquidity grab below the range, followed by a confirmation, which was going to be, in this case, a bullish closure respecting a support level. Now, essentially what happens here on this 15-minute candle is great. You do wick down and essentially grab some liquidity, and then you close bullish. But what's happened here is, quite obviously, this was not enough liquidity, because the market still needed to push down and further break those lows to grab more orders before making a continuation up. Now, if we go back to what I initially teased earlier, the easiest way for you to identify this was to look at what the sessions were doing. Now, Tokyo session low at this point was actually right here. You essentially had a low on Asian right here, essentially putting in that low before London opened and swept them here. Now, once you understand that, and you understand that this 15-minute did sweep below the range, which is great, but once you're that close to the lows, the market is seeing so much liquidity down here below these lows, because that is where the institutions are placing their orders, and the market cannot resist. It's so tasty, it wants to come and grab the orders. So what a profitable trader would do, and essentially what I did, and I can show you the example of this trade that I took live, is wait for the higher time frames to come back down, sweep those lows, sweep that liquidity low like I just showed you on the Asian session. And what it eventually did was sweep the lows and immediately satisfy its craving for liquidity and push to the upside. Now, essentially, let me show you exactly how this plays out in the real market, because as I just said, I took this exact trade right here. But what I did was also combine that with pillar number one, which is market structure. Now I'm going to show you two confluences right here. First of all, you have a 4-hour bullish trend here. We had a 4-hour that was making consistent higher highs and higher lows, leading into essentially a bullish trend. So that is essentially pillar number one stepped off. We have higher highs, higher lows, leading to that bullish trend, which means I'm looking for buys following the trend up. Now, step number two, very simply, is we needed to wait for a simple closure above the range after liquidity. Now, liquidity, like I said, was being grabbed over and over, but it just wasn't enough. even though you'd grabbed a wick below the range, it was not enough. So I identified exactly where that Asia low was, waited for it to be swept, and then instead of waiting for a 15-minute closure, I waited for the 1 hour closure after the liquidity grab. And as you can see, we closed very nice and strong on that 1 hour. So we ended up taking a long position with our stops below that liquidity and our TP heading all the way up towards these range highs. Seeing the setup is only half the battle. Now, the third pillar is really what separates profitable traders from anyone else. And this is where most people are going to give up their edge. Now, a lot of people will be seeing these liquidity grabs and just taking entries willy-nilly like nothing. We need to zoom into the lower time frames to see market structure shifts using pillar number 1 and actually dial in precise entries. Now, this is using something called multi-time frame analysis, which I've made a full video on my YouTube channel in the past. So if you haven't seen it already, make sure you go and check it out because it is very important. But essentially, we are going to need to see shifts in structure and entries printing on the lower time frame in order for us to actually go ahead and get that trade. Now, as you can see, we had the 1 hour confirmation, which was completely great. Very, very clear indication for me that we're going to continue up. But I want to actually get a tighter entry. So how did I do that? Well, essentially, all I did was the exact same as pillar 1, zoom in towards the market structure on the 5-minute time frame, and essentially all you can see is lower lows and lower highs. Now, for me to grab buys in a market that's printing lower lows and lower highs is very difficult. So what I needed to see was quite clearly a strong shift in market structure, followed by a higher low being put in like this, which is now the indication for me that we are shifting in structure. Remember what I said earlier about not getting caught in a fake market structure shift like this? But actually, if you can see a market structure shift where now you put in the low here, followed by a lower high, and then a continuation, now we know it's not a fake market structure shift, okay? Now we have confirmation that we're not gonna go ahead and do what I taught earlier, where we just continue up anyway. We're actually shifting in market structure here because you have not only one market structure shift, you then have 2, and then you have the confirmation on the 3rd. So that is how to identify essentially getting caught in the mistakes of pillar 1. Now, if we go back to the charts here, you can quite clearly see what's going to happen is on the 5-minute time frame, we have a very strong market structure shift. You've come down, you're making lower lows, lower highs, and then you actually go ahead and shift structure on the 5. So you have a 5-minute higher high here, followed by a higher low. Now, the moment this 5-minute candle right here closed bullish, for me, that is an indication now that that higher low is being put in here. You made the higher high. Now, this could continue down and be that liquidity grab like I just showed you, the fake market structure shift. But it actually didn't happen because we go ahead and close bullish, which is indicating to me that we're going to continue up. And essentially now we've dialed in our entries onto the lower time frame. And if you wanted to be really aggressive, you could have actually trailed your stops below this low right here. And essentially, gone break even around here, giving yourself a much tighter risk to reward. However, I was taking the trade on the 1 hour time frame, but using the 5-minute for entries. So I decided not to do that. But look, here's where I'm really going to blow your mind. Getting in the trade is okay, but essentially you need to understand how to manage those trades as well. And everything you've been taught about risk to reward is completely backwards. And the one shift I'm about to show you is exactly what changed my trading career. Now, risk to reward is something that the market uses essentially to identify position sizing and stuff like that. Now, traders have taken this to become gospel and essentially taken away the whole market element of it and decided you have to aim for a specific risk to reward. But this is simply not how the market works. You need to be letting the market dictate what your risk to reward is. Now, I'm going to show you exactly what I mean by that. Firstly, we need to understand where a valid and logical stop loss is. Now, a valid and logical stop loss is always going to be below where the liquidity has been grabbed. Now, the liquidity has been grabbed from here. If the liquidity hadn't been grabbed here, but we expected it to be grabbed around this area, we would still be placing our stops below these lows. Now, essentially, always placing your stops below liquidity is going to allow you to actually have a much higher hit rate in your trades, because even if you're coming down into these areas, the likelihood is once you grab that liquidity, the minimum that's going to happen is you're going to come up towards break even and you can either exit or manage the trade accordingly. But most likely what's going to happen is something like this, where you're just going to continue all the way back up. Now, once we understand that, and we're going to place our stop loss below here, second of all, we need to identify our take profit. Now, take profit is extremely simple. The way we're going to be doing that is by understanding where the next logical resistance area is, or if we're in sells, where the next logical support area is. And this is what is known as a range fill. Now, a range fill, extremely simply, is dictated by the fact that once you close outside of one range or tap into the top of it, you are going to fill the range back down 90% of the time. So as you can see right here, most of the times you close outside of this range, you're filling up towards 62. And if we go to the left, you're going to see that pattern repeated over and over. Every single time you close outside the range, you fill up to at least 62. Close outside this range, at least 62. Close outside, 62. Outside, 62. Every time, minimum, this range is getting tapped, if not more. So for me, that's a very clear identification that I need to see at least 62 being tapped if we close above this range. But actually, we're talking about this immediate range right here. So what actually happens most of the time if we close above this range? Well, this time we came up towards 50. This time we came up towards 50. And every other time we're coming up towards either 50 or 54 right here. As you can see, this time 54, this time 54, this time was 50 again. So now I'm understanding that the minimum area that should be tapped when I enter a trade from the bottom of this range is 50. So my take profit is very simply going to go to 50. I'm not trying to be greedy and take the whole move up to 54. I'm not trying to be greedy and take the next range fill. And I'm also not trying to be too conservative and just take a tiny bit of the pie. I understand that 50 should be tapped into, which is this level right here, and essentially realizing that is exactly where the market should tap into. Now, as you'll notice, when I'm deciding my stop loss and take profit right here, I haven't mentioned risk to reward once. I haven't said my stops are 77 pips, so I need a 2-to-1 or a 1-to-1 or a 3-to-1. I've just let the market dictate where my stop loss should be and my take profit should be. In this case, that rewarded us with a 2-to-1 risk to reward. However, if the market had said, okay, most likely we're going to only come up towards this area right here, which is 40, then essentially all I would do is put my TP at this area right here, and that would be a risk to reward of 0.7. But guess what? The ability and the chance for me to win that trade is 10 times higher than if I just randomly gone for a fixed risk to reward. So I'm letting the market dictate absolutely everything for me, and this is going to give you a massively higher win rate as well as a massively higher profitability, because you are going to be hitting TP more often. You are going to be avoiding stops more often with the stops below the liquidity. And that's the two simple concepts that are going to change everything for your trading. Now, let me show you the exact calculation that convinced me to flip my entire approach. Now, this is getting exciting because you can see the pattern forming, but here's another trade just to reinforce your knowledge and show you exactly what I mean. So as you can see here, we have our ranges set up. Now, this is an actual trade that I took live on stream the other day. Now, this trade was very, very clean. You can quite clearly see we have a level up here towards the top and a level right here, which is our support and resistance zones. And this is the range we are sat in between. Now, what happens right here as New York opens is essentially you come up and start to push above these highs right here. Now, first of all, this is confluence number one, okay? We have bearish market structure, which is pillar number one right here. We have lower lows and lower highs consistently being made. And guess what you can see? The exact fake market structure shift that I told you about in the beginning of the video is about to play out. Now, because we haven't closed above this high right yet, I'm still okay and still understanding that this is still bearish market structure. You haven't made a higher high just yet. You are essentially making equal highs, which for me is making me start to think, okay, maybe we have that fake market structure shift and we're looking for a pullback towards the downside. Pillar number two then comes into play. We have a sweep above the range, a liquidity grab outside of the level up towards here, which is very, very clean. But then adding in the second part of pillar two, what do we have right here? You can see we quite clearly sweeped yesterday's Tokyo and London session highs. So now you have a liquidity sweep outside of the highs of, first of all, London and Asian session yesterday, as well as London session on the current day. So that's liquidity right there. Now, essentially, all I need to see right now is confluence number 3, which is a confirmation closure back inside the range, which is exactly what happens. And then you just need to dial into the lower time frame, find yourself a decent entry point, which is most likely going to be on that 30-minute or the 1 hour, I believe. Once you get a strong bearish closure, you're looking at an entry, understanding the liquidity has been grabbed. And once you take that, you are essentially looking to ride this down towards the bottom of the range. Now, looking at the concepts that I've just shown you about risk to reward and stop loss placement, we're essentially going to expect our trade to be taken somewhere around here. Again, we're going to place our stops above that liquidity right there, understanding there's no real reason for us to need more liquidity after a reaction like this. And then we're going to be placing our TP down towards this area right here for around a 1-to-1 risk to reward. So extremely simple trade. And essentially watching this plays out was very, very clean. Right here, you can see we essentially hit our TP extremely perfectly. And then you do continue down further. But guess what? I don't care, because I'm not interested in taking the entire piece of the pie. All I care about is taking my own part of the move. But this is the moment where everything clicks together. Now, there's one specific pattern that I wait for that gives me the confidence to pull the trigger every single time, and it printed right here on this trade. Now, all I need to see to enable me to take that position is going to be a liquidity grab again on a lower time frame candle, followed by a flip. Now, as you can see, this time frame right here, this candle just came up, grabbed the top wick, and essentially what we can understand is if this candle came up first with a top wick, the moment that candle flips, we have something called momentum. The candle flip provides you with momentum as a sign that we are going to continue downwards after grabbing more liquidity. You can essentially wait for that candle flip or wait for the liquidity grab on that wick and essentially place a sell stop right there. So you don't even need to actually try and find a position up here. You can wait for the more guaranteed top wick candle first, followed by a sell stop on the flip. And taking this is just that one little bit of extra detail that's going to give you more confidence, that's going to allow you to have a better psychology throughout these trades. But look, now you understand the system, but none of this matters without proper risk management. So here's the exact approach that I have that keeps me profitable even during losing streak. Now, you need to be risking an appropriate amount during these trades. For me, the simplest way to be doing that is to be risking 1% of your account. And the reason for that is you are essentially going to need well over 100 trades to actually go ahead and blow your account, risking 1%. And vice versa, when you actually begin to win with 1% risk, that 1% is going to get incrementally bigger each time, leading to 1% being actually a significant amount compared to what you actually started with. And you're going to start to see a pattern like this where your portfolio and your order size consistently grows, which means your profits are also consistently growing. Now, you might be wondering if this only works in Forex, only works with gold, but here's why these principles are universal. Now, I've tested this across multiple markets with students of mine testing it across literally hundreds of different markets. And the reason why this works across every single market is because the principles are the exact same. Every single market needs liquidity to move. Even markets in real life, such as apples or shoes or anything like that. When there is no liquidity, i.e. no buyers, you are unable to sell the shoes that you've bought. When there is no sellers, you are unable to buy shoes. So the same principles are going to apply in every single market. So if you're thinking that this system is only going to work with Forex pairs, you are completely mistaken. But the real secret of this isn't technical, it's psychological, and this is what is going to separate TRLS from every single other approach out there. The psychological edge. Now, this system that I've taught you right here gives you a 3-step process as well as extra confluences to add to your trading in order to give you complete confidence. Now, look, the psychology issues that you are facing do not come from actually having poor psychology. 90% of the time, they come from not having faith in your setups or in the market. But as we understand, I've identified every single aspect of the market that you need to understand in order to be taking successful and profitable trades in the long run. And understanding that and understanding momentum, direction, liquidity, volume, and entry confirmations is going to give you such confidence in these setups that when you're taking a trade, you couldn't even believe it would go against you. You should be taking these positions and thinking to yourself, there's literally no chance that this is going to go against me. And when you have that mindset, it's extremely easy for you to stay disciplined and stay calm. Now, once you've mastered these basics, there are advanced concepts that can take your accuracy even higher, but most traders skip the fundamentals and jump straight for this. Now, I need to be completely honest with you about when this system struggles because no approach works 100% of the time. Now, here's what you need to watch out for. If you are trading during poor conditions, i.e. a ranging market or a low volume market where essentially the market is barely moving, this system is going to struggle because liquidity generation is not optimal. Essentially, the market is not moving as it normally should. As you can see right here, we have low volume, the market struggles to move, and this system is not going to be good during this conditions. As well as that, if you're trading before big news events or during essentially major world events, there is a possibility that the fundamentals could take over and essentially throw all of this out the window. But look, understanding this system is just the beginning, and here's how you develop the consistency that makes it profitable. Because knowing and doing are two different things. What I want you to do is I want you to go away and actually implement these systems and these pillars that you've learned today. Go ahead and learn them, study, and make sure you know them like the back of the hand. Next, I want you to watch the market. Very simply, go and look at the market and identify these pillars in action. Third, I want you to start to take positions on a small account or a demo account and essentially identify your knowledge. Understand whether or not you know these trades well, understand whether or not you know the pillars well, and essentially reinforce your knowledge within them. Whilst you're doing this, I want you to be journaling essentially every single trade that you take so that you can go ahead and actually look at, first of all, the statistics, second of all, where your mindset was and whether you are identifying setups correctly. Once you've done that, go and reflect on your data after a couple of months. If you're not profitable, make the necessary changes. And if you are, you can start to scale up and make serious profit with this. But here's what I want you to understand. This strategy took years to develop, hundreds of hours analyzing charts, and thousands of dollars in losses to perfect. Now, the strategy is extremely simple, but to master it takes time and dedication. Now, if you are serious about learning TRLS and you would like a complete psychological framework to ensure that you can achieve consistent results, I've put together a free WhatsApp group full of absolute killers that goes into way more depth than I can do in just one YouTube video. So if you want that, the link is in the description. Now remember, being consistent in trading is not just about luck. It's about putting together a systematic approach that allows you to get consistent results and has allowed me to achieve an 87% win rate. Now, if you did enjoy the video, make sure you click like and subscribe, and otherwise, I'll see you in the next one.